Welcome to the debate. Our focus today is on a vehicle that millions of people in retirement plans rely on, the Target Date Fund, or TDF. For years, TDFs have been sold as this perfect, automatic, set-it-and-forget-it solution.
And, well, rightly so to a degree. I mean, they did solve a huge complexity barrier that kept a lot of so-called accidental investors from even participating at all.
Absolutely, they solved the participation problem. But what we're seeing now, and especially with the lesson of 2008, is that they've created this massive systemic safety problem. There's a really profound conflict among experts about the inherent risks in these funds, especially as people get close to retirement.
And that conflict really centers on a fundamental and, frankly, a very painful trade-off between securing your assets right now and ensuring those assets are actually enough for a very long future.
Precisely. So the core question we have to tackle is this. Should TDF design prioritize capital preservation during that critical risk zone, the 5 to 10 years right before and after retirement, or should they maintain these aggressive growth allocations throughout life to fight against potential savings shortfalls? I'm going to argue that current TDFs expose investors to an unacceptable risk, a catastrophic risk, and that we need personalized, protective models, like the Soteria framework.
And I'm coming at this from a different angle. While yes, a market crash in that window is undeniably painful, prioritizing short-term safety above all else creates an enormous and verifiable long-term opportunity cost. For most people, the main threat isn't a dip in the market. It's the failure to accumulate enough wealth to fund a 30-year retirement. And that demands sustained growth, even late in the game.
So let me start by just establishing the magnitude of the problem here from the individual investor's perspective. Most people who are defaulted into a TDF, they just assume their money is protected as they get close to retirement. But the data, the history, proves that this assumption is dangerously flawed. We really have to talk about what happened in 2008. The typical 2010 target date fund, which was designed for people retiring around that time, it lost more than 30%. Just think about the behavioral and the financial impact of that for a second. A person works their entire life, and then they see 1/3 of their savings just disappear right when they plan to stop working. They can't just work 4 more years to get that back. Their labor income is ending. This is the absolute peak of sequence of return risk. You're forced to withdraw money while your portfolio is plummeting. And that loss becomes permanent because you miss the recovery, or you panic and sell at the bottom. So we have to move beyond this one-size-fits-all approach that the oligopoly created. The solution, and this is what the Soteria framework is all about, is personalization. It involves shifting the focus from just risk capacity, which is really just a simple metric of your age and your wealth, to genuine risk tolerance, which accounts for an individual's personal, emotional comfort with loss. Soteria introduces what's called the Safe Landing Glide Path, or SLGP. It's a U-shape. The idea is you de-risk dramatically right before you retire to minimize that sequence risk, but then, because retirement could last 30 years, you actually start increasing your equity exposure again later on. This protective move in the risk zone, that's what we call substantive prudence. It's about doing what is actually best for the investor and ensuring their wealth is preserved when it matters most.
I understand the instinct, I do. Nobody denies the psychological and financial devastation of 2008. But I just don't buy the premise that maximizing safety right near the target date is the optimal solution for most participants. The long-term cost of that safety is it's devastatingly high. We have to recognize that the biggest crisis for the average person isn't a single bad year, it's funding a lifetime of expenses. If we look at the AllianceBernstein analysis on this, it's pretty revealing. Their conservative path, they called it Plan C, which kept only 35% in equity at retirement. It demonstrated a clear failure when you test it over longer time horizons. If a 65-year-old was projected to live to 95, that conservative Plan C only provided enough income in just 8% of the historical periods they analyzed. That's a 92% failure rate.
Now, contrast that with their more growth-oriented path, Plan A, which kept 65% equity at retirement. High equity exposure, even as you enter retirement,
is necessary because longevity risk, the risk of outliving your money, is the greatest long-term threat. You need robust returns to offset inflation and withdrawals over 30-plus years. And when you get overly conservative, you incur an enormous opportunity cost. We saw this empirically. My own research with the Smart TDF Index, which used a similar safe landing idea, it severely underperformed the market near the target date for 13 years, from 2009 to 2021, precisely because it was too conservative just as the market started its historic recovery. That lost growth impacts the next 3 decades.
That's a compelling point on the failure rate of Plan C, and I do acknowledge the concept of opportunity cost. But we need to shift our focus from these computer simulations running thousands of trials to the one life path the actual person has. So which risk is truly critical? I argue the immediate, catastrophic impact of sequence of return risk completely outweighs that long-term theoretical opportunity cost for someone who sees their life savings vanish. The goal in the risk zone has to be wealth preservation. The fact is, a retiree can't recover from a 30% loss the way a 35-year-old can. Their income stream is being shut off. Their only option is a permanent, irreversible lowering of their standard of living. And we see massive organizations validating this need for safety. I mean, look at the Federal Thrift Savings Plan, the TSP, the largest defined contribution plan in the world. At its target date, 70% of the funds are in the government-guaranteed G fund that strongly supports the idea that safety has to be paramount at that transition moment. Meanwhile, you have traditional TDFs holding 50% equity and 40% long-term risky bonds. You're looking at 85% risky assets right when withdrawals are starting. That level of exposure is simply unacceptable.
Okay, I acknowledge the scale of the TSP's G fund, but let's be careful about applying that model universally. The TSP is fundamentally different. Many of those participants have a defined benefit pension or military pension to supplement their savings. Are we really comparing apples and oranges when we talk about a typical corporate 401k participant who relies entirely on their TDF?
You focus on sequence of return risk as this catastrophic event, and in the short term, it absolutely is. But sequence of return risk is just market volatility happening at a really unfortunate time. Let's contrast that with the quantifiable, devastating effect of not having enough money over decades. You call it theoretical growth. Let's put a number on it. Research consistently shows that giving up just a 1% higher annual return because you got too safe too early can cost a participant the funding for more than 10 additional years of retirement.
You're trading the immediate psychological relief of avoiding volatility for a lifetime of higher financial insecurity. To me, the cost of that safety is just too high when you consider the full longevity risk.
And that difference in perspective brings us directly to our second point, the efficacy of personalization, which is really central to the Soteria solution. Soteria directly addresses this structural flaw of a system, the one-size-fits-all default, by recognizing that investing is deeply personal, even for people who were defaulted in. We correct this by integrating academic theory, specifically human capital theory, with an individual's psychological risk tolerance. See, it's not enough to just say a 50-year-old can handle 50% equity. We need to know if they will handle it without panic selling at the very bottom of the market. So Soteria uses a suite of glide paths, conservative, moderate, aggressive, not just one single line. This empowers participants to manage their unique situations, and it's a breakthrough for financial advisors who can now bring this science to clients in both retirement plans and IRAs. And crucially, for the plan sponsors, this customization offers a master customized TDF QDI. It allows the plan to control the base risk level and move away from those demonstrably dangerous, standardized paths. It lets the plan sponsors actually move toward a more fiduciary process.
I agree that the risk tolerance component is theoretically superior to just using age and savings. I do. But we have to be grounded in the reality of the participant pool here. Personalization. It runs directly counter to the fundamental utility of the target date fund, especially for that accidental investor, the person who chose the TDF precisely because they were overwhelmed with options.
Right. I mean, to get these investors to succeed, the requirement has to be limited and simple. If we start introducing the ability for an individual to choose and blend different risk levels, Well, aren't we just reintroducing the very complexity that TDFs were designed to eliminate? The whole point of the Qualified Default Investment Alternative, the QDIA, was to be a simple, safe harbor. The question isn't whether deep customization could lead to better outcomes.
It's whether asking participants to engage with complex risk blends provides any real utility, or if it just gives them enough rope to hang themselves by choosing the wrong path during a downturn. A simple, well-designed, high-growth default for the masses might still outperform a customized system that relies on the financial acumen of those least inclined to engage.
That's a valid skepticism about engagement, but the premise that we must avoid complexity at the cost of safety is exactly what we're challenging. Soteria doesn't demand engagement. It offers it, but it also provides a carefully constructed, personalized default for those who don't choose. It's a spectrum. And the personalization isn't just about the individual. It's about giving the plan fiduciary the tools, the master TDF, to set a more appropriate risk profile based on their own employee demographics, which is already a huge step up from the generic paths. We're increasing fiduciary control, not just participant confusion.
Okay, let's pivot to the fiduciary obligation then, because this is where the rubber meets the road. I maintain that true substantive prudence demands that we prioritize growth. When we look at that high equity exposure in Plan A, the 65% equity plan, it delivered the best lifetime outcomes. It minimized the greatest risk, running out of money. Myopically focusing on minimizing short-term volatility, avoiding that 30% loss, comes at the cost of increasing savings shortfall risk and longevity risk. These are the main risks over a full lifetime. If a participant sacrifices years of crucial compounding by getting too conservative too early, they are exchanging the risk of a market correction for the risk of poverty in old age. I believe that Plan A, the highest equity path, was arguably the substantively prudent choice because it maximized long-term outcomes. Growth and prudence are not mutually exclusive.
I have to disagree that simplicity justifies imprudence, or that maximizing a theoretical expected value trumps avoiding ruin. The core issue remains fiduciary duty, and whether fiduciaries are breaching their duty of care by choosing these high-risk defaults. When a TDF has 50% or more in stocks right at the target date, given what we know about sequence of return risk, I maintain that is structurally imprudent. It's dangerous. We have to distinguish between procedural prudence, which is just following the crowd, using a big brand name, and substantive prudence, which is doing what is actually right for the investor. The fact that congressional committees have launched inquiries into TDFs because they are concerned they're placing savers at risk, that underscores this fiduciary gap. The fact that some lawsuits failed doesn't negate the danger.
Soteria's safe landing glide path is the ethical and, I'd say, legally safer path forward because it mitigates that known immediate risk.
I understand the legal sensitivity, but the fiduciary duty is complex. If you tell a client, take this safe path, but just so you know, you will likely run out of money at age 85 instead of 95, have you fulfilled your duty? Procedural prudence sometimes means choosing the model designed to maximize the longevity of savings, even with short-term volatility. By moving people into a conservative mode too early, say at 55, you're locking in lower returns for a decade. That lost capital may be the difference between a successful retirement and a failed one. The ultimate risk to the fiduciary is the plan failing to provide adequate income for someone's entire life, not just failing to avoid one bad quarter.
I see why you frame it that way, focusing on that ultimate horizon. But the behavioral reality is that if a participant loses 30% right before retirement, they can't access the long-time horizon you're talking about. They are forced to live smaller today. Substantive prudence has to protect the capital right when it is needed, which is in the risk zone. Soteria moves the industry toward recognizing that the landscape is changing and requires a dynamic, personalized path that prioritizes avoiding ruin, not just maximizing the highest possible theoretical return. Our discussion really highlights this essential, difficult tension in retirement investing. I still maintain that the unique vulnerability of the risk zone, when sequence of return risk peaks, requires deliberate structural protection. Soteria delivers this necessary personalization and the safe landing glide path to ensure participants can avoid ruinous losses, and in doing so, it fulfills a higher substantive standard of fiduciary care.
We can't mistake accumulated capital for safety if that capital is totally exposed to a crash right before it's needed.
And I reaffirm my conviction that for a retirement horizon that spans 30 years, maximizing capital accumulation and maintaining growth have to remain the primary goal. While short-term safety is desired, the historical evidence, especially on the low survival rates of conservative plans, shows that these overly safe paths ultimately pose a greater threat to retirement adequacy than measured market risk. The difference between the highest and lowest equity paths can be measured in hundreds of thousands of dollars. That longevity opportunity cost simply cannot be ignored.
The retirement investing world is changing. Financial advisors should recognize that Soteria is taking the lead towards safety and personalization. Advisors to retirement plans can bring this breakthrough, the master, customized TDF QDIA, to their clients, allowing the plan to finally take control over risk.
And advisors to individuals should embrace the science of lifetime investing paths that Soteria represents. It allows them to serve their clients effectively, whether they're inside a retirement plan or managing individual retirement accounts.
Thank you for joining us for the debate.